So elementary and high school, back to school this past week here in Florida. A week ahead, that's kind of when colleges kind of get kicked off. And this weekend, for many parents, marked that weekend of transition where you drop your college student off at his dorm or his apartment. And, beyond saying goodbye to the kids, it probably... you're at the point in the summer where you're like, okay, I'm okay with you going back off to college. The issue there, when we think about college, of course, is the cost. And unfortunately, on the program, we're going to share with you a disturbing trend involving how people are paying for college these days. And most importantly, give you some alternatives to help you out from a financial perspective. And then we're going to talk a little bit about how you can conquer your fear of investing and start saving money for the future. We've got one of the Gen Zers at Nelson Financial Planning on this week's program to help us delve into this topic, because the fear of investing is actually at a very high point when it comes to younger generations. So welcome into the program, Chet Cowart. How are you this morning?
Doing great. Thanks for having me back. Looking forward to diving into all that, clearing up Gen Z's image.
There you go. That's always a good thing. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the region, plus also a variety of podcast channels as well. To connect, go to our website, nelsonfinancialplanning.com. And while you're there, you can also schedule an absolutely free consultation at any point in time to see how we might be able to help you. So my name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks just like Chad who are certified financial fiduciaries as well that are ready to help you change your life with a successful and cost-effective financial plan. So, Chet, you're one of those Gen Zers, but you barely make it in. You're really more of almost a millennial, but not quite. As we were preparing for the show, a lot of your peers are kind of just sticking money in money markets and CDs and savings accounts.
Yeah, I can think of a handful of my personal friends that are sticking with that strategy: CDs, money markets, even just compiling all of their money in checking accounts. I find it interesting because we've talked about it before on the show, the rise of financial content on things like TikTok and Instagram. So the exposure is definitely there, but in my experience, just based off of the conversations I've had with them, it seems to be a fear of losing your money, a fear of the market as a whole, and just lack of education mostly. So yeah, I have definitely seen that, and it's concerning because over time, the performance is not there.
Well, that is very true, and that is interesting because you would think in today's world, you got all the information is out there, readily available, but if anything, I think the greater the amount of information out there, the harder it is to get educated.
Right. Yeah. I mean, it's confusing and overwhelming a lot with some of the information that's out there, and I think when you're bombarded with all that information, the easy thing to do is just say, I'm not going to participate, and I'm going to just keep it in checking where I'm comfortable. And obviously, there is a lot of fear in the market, and there always has been, and there always will be, but that's not a good long-term strategy.
Well, and fear is a powerful human emotion. Mm-hmm. It creates, I think, according to a study, it creates a 3 times more of an emotional response than, say, greed. Mm-hmm. So it's pretty significant. But I think the thing that folks have to obviously watch out for, if you're talking about CDs, savings, money markets, is that that's a problem from a long-term perspective in terms of your return, as you were mentioning earlier. But considering the data that just came out this past week, it's probably going to become a problem in the more immediate impact as well.
Right. Yeah. The inflation data has recently come in, holding steady at 2.7, which was just below the 2.8 rise that was expected. So inflation's holding steady. That's a big problem if you're keeping your money in a checking account or a savings account, or even money markets will continue to fall. And considering inflation is holding steady, I think that's going to lead to the Fed lowering rates in September. So that's only going to make these money market rates fall even more.
Well, and that's going to have a direct impact on then the interest rates as well. I mean, the fact that when the inflation data that came out this past week did not see or not contain a more sort of alarming acceleration in terms of price pressures really does probably remove one of the obstacles that the Fed had in terms of their hesitancy to cut rates. They were hesitant to cut rates in July. The employment data has continued to come out a little bit weaker since then, and but inflation somewhat staying in check. So I think certainly it makes sense to try and see them cut rates, and when they do, then that's going to immediately trickle into how much interest you're seeing on those money market and CDs.
Mm-hmm. Yeah, I mean, just as recently as a year ago, they were up around 5%, and now they're below 3%, and that trend will probably continue. And then that's obviously before taxes that you pay, and then factor in inflation, and your real returns on that money sitting in a CD or money market or even checking account could be negative at the end of the day.
No, that's exactly right. Taxes and inflation, those are things that are always out there, always the case. Hey, speaking of things that are always the case, this program, or at least the podcast version of this program, made yet another top podcast list, courtesy of the folks at FeedSpot. For those of you who don't know who FeedSpot is, they are basically sort of a podcast aggregator out there for content that's all over the world, about 7 million users per day. This marks the 5th year in a row where we have made one of their top lists based on quality of content. So I guess in the past we've made their top 25 financial planning podcasts. This time we made their best planning podcast lists. A total of 40 different podcasts were selected. And we were number 5 of the best planning podcasts worth listening to in 2025. So I guess yay us.
Yeah, exciting stuff. We get many listeners on a bunch of different platforms. We upload to SoundCloud, YouTube, all of this stuff, and we've had something close to 50,000 downloads of our show over time, so we must be doing something right.
Yeah, there you go. That's about 25 a day if you kind of run the math on that, and whether it's Spotify or iTunes or whatever the case may be. If you're not catching the program on a podcast channel, then you should be, because you can always listen and access those at any point in time. Now, to be candid, Chet, when we talk about our podcast numbers, they pale in comparison to the big news out of the podcast universe this past week, which was obviously the Taylor Swift joining the Kelsey brothers on their program. We're not exactly hitting those kinds of numbers.
And that was big news in my circle, in my life. So I'm glad it made it into this show.
You're not. I don't think you're being serious here. No. Yes, we tried to get Taylor on this week's program, but she had already done. She only does one podcast per week, and so she went with the Kelsey version. So anyway, the beauty of podcasts, right? No commercials.
No commercials, which is a rarity these days. So we can proudly say that we have no commercials.
There you go. Kind of makes you wonder about the viability of terrestrial radio over the next 5 to 10 years, unfortunately, right? When was the last time you listened to the radio in your car?
I mean, aside from when the 5-second period of time before my phone connects to the car automatically, that would be the last time. So, aside from that, it's been quite a while.
Progress, I guess, is what you call that. So up next on the program, as you drop your kid off to college for the weekend, or I guess, the program airs on Sunday, so maybe you're probably actually returning from that experience, maybe a little misty in the eyes or something like that. We're going to talk about, are you paying for it the right way or the wrong way. There's been some disturbing studies of late that have come out that suggest that more and more, to the extent that folks are going off to college and parents are paying for it, well, they're using not exactly the best possible options when it comes to financing that. So we're going to chew through that here in the next segment here on Dollars and Cents with Joel Garris, Chet Cowart of Nelson Financial Planning. Sort of back to school time, folks dropping kids off from college, and we figured it would be a good time to sort of talk about how you pay for that before you kind of get out of the door on that. Chet, it's not cheap, is it?
No, it's not. We have some interesting data in terms of the amount that is being paid and also how people are paying for it is certainly not cheap.
Well, and that's the new data from Sallie Mae in terms of their annual survey. So tell us a little bit about kind of what that report is showing these days.
Yeah, it's showing how just a troubling way in which people are paying for school. So we see a higher amount of home equity loans, withdrawals from retirement accounts, credit cards being used. Parents reported paying over $30,000 per year for school, which is certainly significant. And you have 18 years typically of runway to get in front of that. So there's certainly better ways to go about it than pulling from your 401k or paying with credit cards, especially with where interest rates are. That's a losing proposition for sure.
No doubt. And at least the silver lining, I guess, with all of that data that was in that report out of Sallie Mae is that about a third of parents use 529 plans to help pay for educating their kids. Although the issue there, as you kind of look at the data, is that number really hasn't changed for many years. So that makes you think that, folks are not necessarily really giving a lot of credence or additional dollars into those college savings types of plans.
Right. I mean, it shows that, that 32% is great. That means that there's, a good chunk of people that are using these accounts and are aware of them. But with the fact that number isn't rising kind of shows a lack of education for new parents that they're available to you. So.
No, absolutely. And the report, and this report is titled, How America Pays for College. It also had, some eye-opening stats of how much current income parents use to help fund college. In fact, about nearly 60% of parents actually took money from their current income and to pay for college. The average amount was like $9,500. That's not an insignificant hit to your normal income.
No, absolutely not. I mean, that's a large percentage of many's annual income, and that can certainly put a strain on your budget and your monthly cash flow. That's
one of the many reasons why I remember my late father-in-law, Jack Nelson, saying to clients, when the kids graduate from college, you're rich. Mm-hmm. And that is very, very true. And certainly the numbers in the report would back that up. I guess the asterisk on that is you're rich as long as they don't move back home. Right. And then you kind of have to support them. So you want them to graduate from college and then you become rich and make sure that they've got a job as well. I guess that's where the parental coaching of degree choice matters. Right? Yes, whole different topic and one that only has gotten more complicated with some of this AI stuff. This AI stuff is real, and it's starting to show up across the board, and in particular in the job market. But really, Chet, you point out, you got a long runway. You got newborn, and you got 18 years before they go off to college. So there's certainly some strategies that you can start to look at to help make sure that this is not going to be a major burden.
Yeah. I mean, you have a typically 18-year runway to think about this sort of thing. And granted, it's not a new parent of a newborn. Maybe that's not their first thought. Busy time. But the sooner that you get in front of it, you can really alleviate some of these issues with accounts that we talk about these a lot. 529s, they're a very powerful tool. I mean, the money grows tax deferred, and then these withdrawals are tax free when you pay for qualified educational expenses, things like tuition, and folks, even trade schools, are covered. So absolutely a powerful tool, and as with anything in the investment world, the earlier that you get started, the better.
I was thinking about this. In today's world, Roth's obviously very, very popular, right? So with the Roth, you put in money on an after-tax basis, and then you get to spend it in retirement tax-free. That's the concept. Well, a 529 savings plan is identical to that.
Right.
And as popular as the Roth is, for whatever reason, 529s, the popularity of 529 college savings plans, as this data is showing, really hasn't changed at all over the course of the past several years. And it surprises me, given how much people obviously want to see, their kid go to college. It's, obviously the landscape may have changed with AI and trades and things like that, but it's still viewed as a pathway to sort of upward economic mobility, and it's certainly neat to see that is still valued here in this country. When you look at the number of graduates that are first-generation graduates, about a third of graduates in America today are first-generation graduates. First kid in the family to have gone to school, graduated. That's really kind of a neat statistic that talks about the upward mobility that is America.
Absolutely, and with these 529 accounts, another thing that's not considered a lot is just the flexibility with them in terms of moving from one beneficiary to another and allowing it to continue from generation to generation. They're very powerful tools, and they can certainly help with the cost, because it's only going up. I suspect that the cost of college is not going to go down anytime soon.
Well, it was certainly neat to see my middle son, Ethan, graduated from UVA this past May. And so at UVA, if you're a first-gen graduate, you get to kind of have a little stole on your robe. And just the amount of stoles that were in the graduating class, it's just, it's great to see. But the reality is that you want to make sure that you're not creating a long-term financial problem when it comes to college, because you can't. It's hard to get out of these college loans, especially in the current environment where there's obviously a new sheriff in town there in Washington, and this notion of deferments and income repayments and forgiveness, that's kind of out the window.
No, absolutely. I can speak again to my own, circle of friends. A lot of them do have student loans, some more than others, of course. But as you were saying, the odds of those being forgiven are dwindling. They're not bankruptable, and they will continue to grow if you don't pay on them. And it's again, just with anything, getting in front of it as early as possible with something like a 529 is really going to help with that.
Well, the other thing the Sallie Mae report showed is, obviously a real squeeze going on in terms of where the money is coming from. We talked about $9,500 per year on average coming from income, but there's also been a pretty significant jump in sort of borrowing from home equity loans, taking equity out of properties. The number was $5,800 per year, which that's about a 100% increase over previous years. And you take that number, you multiply it by 4. I mean, that's $25,000. That's a real hit to your retirement, to your home equity, and heaven forbid, let's hope it's not sitting on a credit card. Right.
Yeah. I mean, the same things are happening with credit cards and loans from retirement accounts. Parent loans, retirement savings withdrawals, they're all growing in the amount that parents are taking out to pay for school. So it shows a lack of use, of these tax advantaged accounts. And I guess the fact that college is just getting more expensive.
Well, there's more than one, right? I mean, so you got the College Savings 529, which I think is the most powerful, most flexible one. On a lower scale is the educational savings account. It operates the same way. After-tax money goes in, take money out for educational expenses. It's tax-free. But there's some income and very low contribution limits that you can have on that. Minor's account is another option where you set money, but that's in the kid's name, so that can create some issues. But there's definitely some options in that Roth sort of type with that 529. That's really a very powerful alternative. So we're going to take a break and continue the conversation here on Dollars and Cents with Joel Garris and Chet Cowart of Nelson Financial Planning.
Got a lot to talk about this segment about the fear of investing and how a lot of people hold out.
Yeah, this is real, and we just see it time and time again, and thought it would be a good topic of conversation because it's not going away anytime soon, but the more you're making choices about your money and about your finances based on kind of that fear, the more you really could be doing some long-term permanent damage to your investment results.
Right. I mean, so we were looking at an article earlier, some data from the World Economic Forum. 40% of those surveyed did not invest in the stock market due to a fear of losing money. And the fear is certainly real. The market can be volatile, but of course the actual cost of not investing over time is much more significant than anything that fear can cost.
Well, and back to what we were talking about at the beginning of the program, where you were sharing, it seems like a lot of folks your age, which is odd that Gen Z, millennials would be steering in this direction, but it seems like overwhelmingly there's that push to, hey, I'm not going to invest in the market, despite all of the information out there. It's crazy how much information is out there on it. But yet, you've got a couple of different generations that are really just saying, I'm going to go ahead and just kind of stick the money in a savings account, money market, or as one of your buddies is doing, just straight in a checking account.
Yeah, I mean, call it what, is it a lack of education? Probably that's certainly a part of it. I mean, for the last few years, money market rates and CD rates have certainly been attractive, so I think it's made that decision to invest in the market maybe a little bit more difficult. But we expect those to fall. They already have started falling, and they will likely continue to fall with the possible rate cuts in September.
Yeah, I mean, it's interesting. Speaking of kind of all the available options out there, social media, one of the top comments, even on like financial influencer, TikTok or YouTube, it basically kind of echoes one sentiment, which is that I want to invest, but I'm scared. Of course, if you spend a lot of time on social media and whatnot, you're probably scared anyway, because again, fear sells more than
right.
Positive stories. But it can be a major impediment in terms of how big of an impact that fear can put on how you do well, how you do in terms of your investments and your finances over time.
Right, and I mean, there's a lot that can be done to help alleviate these fears. One of which is just your choice of investments. You don't need to be buying options or buying things on leverage or emerging market companies. Something like a mutual fund. You're investing in hundreds of companies. The success or failure of one singular company does not decide your returns at the end of the day. So it's really investment choice and of course education at the end of the day, which is what we're here for.
Well, and Chet, mutual fund, obviously created nearly 100 years ago to give the average investor, the regular investor, the opportunity to be able to invest and have a diversified portfolio without having to make a significant investment. When you buy a share of a mutual fund, I mean, mutual fund shares can be, $10, $20 a share. And at the end of the day, there's usually 200-300 companies in there. And that gives you pretty good diversification where, this notion of, I'm going to lose all of my money, right. The mutual fund really makes that very difficult to do, because if you're going to lose all your money in a mutual fund, you're going to need 200 or 300 of what are arguably the largest companies in the country to all go out of business and all go out of business at the same time.
Right, incredibly unlikely, and at that point, what is your mutual fund worth? It's probably canned food time.
Yeah. I mean, if you got 300 of the largest companies in America going out of business at the same time, you most likely have much bigger issues that you need to be worrying about. The big wave or the big mushroom cloud, probably your first indication.
Right.
But certainly. With mutual funds, one of the easiest ways to sort of dip your toe into it, as we were talking about this past week, is this notion of employer-sponsored retirement plans.
Yeah, that's a great way, to just gain a little bit of experience in the market. Most people are offered something like that through their employer. You contribute a little bit every paycheck, and I think the biggest thing is that fear, and what happens when you consistently invest in those accounts is you see the money gradually grow over time. You get a little bit comfortable with the swings of the market and the volatility, and it becomes less of an issue.
Well, and then from there, you toss in the potential of an employer match, right? A lot of employers these days will have a match, and then give you the option. And a lot of times, actually, you're almost automatically required to contribute now. There's a lot of automatic provisions that sort of push people into these, saving in these plans, which is great. These days, you can also do kind of a Roth basis as well. That didn't exist, a few years ago. Plus, the fundamental value of making those regular contributions. I mean, that's all about what dollar cost averaging is all about.
Right. It's a very powerful tool. The concept of dollar cost averaging being investing the same amount of money over time on the same date consistently, no matter what the market is doing. You buy more shares when the market's down, you buy less when the market's up, and you kind of smooth out the volatility, lower your cost basis. It's a great way to do it.
Yeah, great way to build wealth over time. But that being said, I mean, obviously, we can't ignore the fact that certainly the market can be pretty volatile at times, and but just to have that perspective that folks need to have. You think, we were talking about this. You think back to just what's gone on over the past 5 years.
Right. Yeah. No. I think about this sometimes, and it makes me laugh. If you had a crystal ball 5 years ago in 2020, and you knew everything that was on the horizon. You saw, okay, so we're going to have a global pandemic.
Yeah.
We're going to have inflation above 9%, wars in Ukraine and the Middle East, a trade war with China, all these things packed into half a decade, which is not that long in the grand scheme of things. Would you have been excited to invest, in the stock market? The answer is probably no. I wouldn't have been. But since then, the S&P 500 has doubled. It's gone up 100%. So your money also would have doubled, assuming investment in an index tracking fund like that. And that just goes to show that there really is never a great time to invest, is there?
No, and I guess it just when you think about that, the perspective of all of those events that have happened just in the past 5 years, I think that underscores that those headlines are always out there. You can go back in time, history of the market, and there's always something going on that serves as a distraction that helps to stoke the fear of that our investors have, which is what we're talking about today.
Absolutely. And another quote that I like a lot, this is from former Capital Group American Funds executive Graham Holloway. In my 25 years in the mutual fund business, I've never known a good time to invest. There are always a dozen reasons why it makes sense to wait. We have a new president, strife in the Middle East, excessive government regulation, and oppressive tax rates, and a Congress that is more part of the problem than part of the solution. That sounds, very similar to what a lot of people may say right now, but that quote's actually from 25 years ago.
Even longer. I think it goes back to 1981.
You're right.
Is when that quote was
much
from.
longer than 25 years ago.
So, I mean, when you think of that, there's, the beauty of that quote is, talking about, issues in the Middle East, issues in Washington, issues in this country, that hasn't necessarily changed a whole lot.
No. there's never a time when it seems like, the best time to get in, a perfect time to get in. It's you just, as time in the market is what matters, and the best time to start was yesterday. Second best time is today.
Well, that's a great way to say it. In our book, Next Gen Dollars and Cents actually has a pretty good chart that really helps to describe this pretty graphically, and so we're going to kind of work through that chart. But first, we're going to slide to a break. When we come back, we're going to talk a little bit more and give you some of the details on this very simple chart that we feature in our book, Next Gen Dollars and Cents, available on Amazon, or if you come to the office, courtesy of making an appointment through our website at nelsonfinancialplanning.com, and really kind of work through and help to really underscore why waiting is going to cost you much more emotional pain than whatever your fear of investing is today. Coming up next here on Dollars and Cents. So we're talking a little bit about how much procrastination can cost someone, and tying that into this statistic, Chet, that you were sharing earlier about how 40% of the population, out of fear of investing, is not investing, right. and putting that off can be a major problem and a major limitation with ultimately what your bottom line investment results are when you get to retirement.
Yeah, absolutely. Waiting and procrastinating the costs we all kind of know that in the back of our head, but when you see a chart like this that we have, it really helps to illustrate how significant the procrastination costs can be.
Well, we've been using a chart very, very similar to this for 40-odd years here at Nelson Financial Planning. And so we obviously, given how often we use it, and that it really does kind of underscore, you can't let that fear of investing cause you to delay any more than it probably has, or avoid in investing altogether. So this chart we've got in our book, Next Gen Dollars and Cents, and just assumes a 10% return, which is in line with kind of the 80-year, 90-year historical average in the markets, and it looks at two different investors. Right? You've got investor A, who started at age 22 and invests $250 a month and does it for 10 years and then stops. Right. And then investor B, who, waits 10 years, starts at age 32, right when investor A is stopping because they've already done it for 10 years. But in this case, investor B, who starts at 32, invests the same amount of money, $250 a month. He continues to do it for a total of 34 years through age 65. Bottom line, there's a pretty big gap here.
A huge gap, and it's crazy to have it illustrated in front of you like this. The significance. This investor A, who started at 22 years old, invested $250 per month for only 10 years and stops forever. At age 65, he has $1.3 to $1.4 million. This investor B, who starts at 32, invests the same amount of money per month for over 3 times the amount of time, all the way to 65, ends up investing a total of $102,000 and only coming out with about $800,000 in retirement. That's a big difference.
Yeah, when you think about $800,000 versus $1.3 million, that's a pretty significant differential in terms of what those bottom line numbers are. That's basically 66% more money.
Right.
Just by starting 10 years early.
And investor A has only put in $30,000 of their own money.
Puts in less money.
Not only do you have more, but you've contributed just 30% of what investor B did.
Well, and look, here's the reality. If maybe you're not 22 anymore, maybe you're 32, okay? Start. Because if you wait another 10 years and you're 40, these numbers continue to get much greater spread if you're not addressing exactly what you need to be doing, which is just saving a little bit of money along the way.
Right. No matter what age you are, these numbers still apply. Whatever 10-year age gap you see or time gap here that illustrates the difference in the end result. That there's no sense in waiting, no matter what age you are.
Well, and I've been doing this a little longer than you have, Chet. I've certainly seen many examples in my career, folks that started decades ago at Nelson Financial Planning, and just started out with $100 a month, and stuck with it over obviously an extended time period. I mean, those are the real stories of real people that we really enjoy at Nelson Financial Planning, and so enjoy working with them and helping them. Also a big reason why we've never had account minimum.
Right. I mean, those are some of the biggest success stories, that we have at the firm. Those people that started with just $100 a month are oftentimes our, biggest clients. And it's not because they came into a bunch of money or were doctors and lawyers and made a bunch of money throughout their career. They were just consistent over time.
No, absolutely. So bottom line, folks, if the fear of kind of the stock market is causing you to delay, we want you to think about these numbers, think about these strategies, right? It's about time in, not timing. It's dollar cost averaging. Taking advantage of what your employer gives you in terms of those retirement plans at work. And then lastly, certainly it's about education.
Right. That's what we try to do every day. That's why we have, continuing education for all of our clients. That's why we do the radio show, and it's why we're always available on the phone to connect with people and educate and alleviate some of these fears. I have those phone calls relatively often, which is it's more of a counseling phone call than a financial phone call, but it's very necessary because a lot of this is behavioral.
Yes, oftentimes I think a psychology degree rather than a finance degree would have been much better in this line of work when it comes to helping to provide perspective when it comes to finances. It's such an emotional topic, and fear can really be a major component in it. Also why we wrote the book, Next Gen Dollars and Cents. Also in the process of doing a workbook that's going to complement that book. That workbook should be out this fall, so make sure you call the office or fill out your request on our website at Nelson Financial Planning. For the workbook, we anticipate sort of a fall, October-ish release date on that. It's a companion workbook designed to really help some of these principles that we talk about in the book to be a part of really committing to them and getting a better understanding of what they're all about.
Yeah, I think it really helps to relate it back to your own situation. The book is amazing, but it's you can only read so much when you actually sit down and begin to apply it into your own life. It becomes powerful. Yeah,
working the problem out, actually doing the example, all of that. You really can assimilate it much, much better. So we're excited about the workbook. Again, that's going to come out in October, and I guess by October it'll be usually there's like a little break. So your college student might be home again after you've dropped them off this past weekend, and really there's some good options out there in terms of how you can better save for retirement. The stats that we were sharing earlier on the program really do show a little bit of a disturbing trend in terms of how people are paying for college in the first place.
Absolutely, yeah. There's a big rise in not only parents paying for college just with their yearly income from work, but also from workplace retirement accounts, home equity loans, credit cards, things of that nature. It just kind of goes to show a lack of education and maybe a lack of pre-planning for this sort of thing.
Well, and that really does get us into kind of what we were talking a little bit earlier about on the program, is that, look, there are options. And as you pointed out a few times, there's a long runway. When you've got an infant and 18, that's a long enough runway to really kind of think through and strategize. How do I best prepare for this? And there's a lot of options in which to do that.
Yeah, I mean, we're obviously big fans of the 529, just due to its flexibility in terms of not only what you can use the money for, but then also how you can pass the money along if it's not used. If your kid doesn't go to college for whatever reason, it can be kind of spread to another family member. So yeah, we're big fans of those, and it's more people should be taking advantage of them.
Well, and look, the ability to use those types of accounts continues to expand. Even the one big beautiful bill that was passed last month, that even dealt with further expanding out the definition of qualified educational expenses that you can use that money for in those accounts on a tax-free basis, that you can then utilize and pay for a much broader range of expenses, some of which are picking up continuing education, professional certifications. I mean, there really was a further expansion of what you can use those accounts for.
Right, and with a long runway like we talked about, I mean, even $25 or $50 per month can be the difference between student loans or no student loans. It really doesn't have to be a significant cost in your life. It's just about getting in front of it.
So maybe that weekend of dropping your kid off to college is 18 years away, or 17 years away, or 16 or 15, or wherever you're at. Understand that it's best to always kind of get started to make sure that you are putting some money away towards that. Certainly the 529s, which really do kind of operate like a Roth, if you will. You put the money in after tax, take it out tax-free, assuming it's a qualified educational expense. Pretty good vehicle.
Absolutely. Very good vehicle.
Well, we're going to wrap it on up and get on out of here. Thanks for listening to this week's program here on Dollars and Cents with Joel Garris and Chet Cowart at Nelson Financial Planning. Make sure you check out our website this week at nelsonfinancialplanning.com. Thanks for listening to this week's program.